Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer, and today we're going to be analyzing Molina Healthcare stock. This one came in by request down in the comments section of one of my other videos. If you have a request, just drop it down in the comments section, and I will eventually make a video of it. I'll get it on the whiteboard behind me so I can keep track of the requests. And if it's a stock that's in the S&P 500, which Molina is, I'll post the video on YouTube for free. If it's not, I'll post it on Patreon, which is $5 a month. And then if you join there, you get a big discount if you choose to join the full Cyclical Investors Club service over on Seeking Alpha, where I have all the spreadsheets and the chat room and lots of other articles and all kinds of great stuff. If you're interested in the full service, and those links will be down in the description. As always, this isn't individual investing advice. This is just how I analyze stocks. So let's get into Molina here. I didn't track Molina until I got this request. And the reason is, so whenever I'm looking through stocks, and I look through literally thousands of stocks individually over the past several years, the first thing I always look at is the historical earnings, especially the cyclicality or the general pattern that I see. And when I looked at Molina, there's two things that kind of jumped out at me. So let's back this up a little bit to where I probably would have initially looked at it. So one is there's this long period of kind of decline and stagnation, sort of a combination between the two. And then we have this kind of odd year here in 2017 where earnings were deeply negative, or at least adjusted earnings. I'm not sure exactly what this is from. It looks like some sort of snafu or something. But usually if it was just this, I would probably have investigated it a little bit more just to see what was going on. I'm still actually haven't looked deep enough into it to totally explain what happened here. It might just be like an accounting thing, which does happen sometimes. But the more concerning thing that kept me away was just this long period of kind of stagnation before, and then combined with this, when I look at that, I'm like, well, there's plenty of other like healthcare stocks that don't have this. And so because I look at so many stocks, I in about 60 seconds would just put this one in the too hard or avoid, or just not kind of worth my time, because I can look at other ones and that are kind of similar and they don't have those problems, and I can just buy them, which I actually have. Even on this channel back in 2021, I bought Anthem. That's been a big winner and outperformed the S&P 500. In 2022, I posted a video on Cigna and wrote articles on these two. I still own both of those, and they've both outperformed. So there's opportunities there. There's enough opportunities where it's not like this is like a rare pick that maybe there's something special about it that's going to come out that people weren't aware of, where it's worth maybe doing like a bunch of extra work. So this one just kind of went into the ignore pile, I guess, if there's such a thing. But since I got a request for it, I was like, okay, well, and I do try to do this sometimes when I get requests from my service members. A lot of times there's things that I just kind of push off to the side, but I always kind of take a deep breath and say, okay, well, let's just clear my mind and look at this and see, what I could do, even if it's just offering a little bit of feedback beyond my initial rejection. So when I would first look at this personally, I'd be like, well, that's too much work to like figure out. There's 5 or 6 other companies that do similar things. I'll just look at them, and they often trade similarly anyway. So this kind of goes for any industry. If there's, well, really almost anything. If there's 3 or 4 companies and one of them has something weird going on, or that makes it harder for me to look at it or understand it, I just ignore that one and focus on the other 3 or 4 that I don't have to deal with that. A great example, which I did post a video on this earlier, is advanced auto parts, right? So I own AutoZone. I almost bought O'Reilly during the 2020 dip. I was able to get AutoZone, and my video was about avoiding advanced auto parts. Well, here you go. You have three businesses that are basically the same. One of them was was poor. Like there were things that there were kind of warning signs that they weren't doing as well. Well, if you have all three of them and they kind of trade together, buy the two that you don't have those issues with. And that ended up being a good warning video. Let's just look at it real quick. So I forget exactly. I think maybe revenues is what I was looking at. Maybe it was the stagnation of real earnings growth. I forget exactly what I said in the video. But it was somewhere here before it fell this gigantic amount, because it was starting to look kind of cheap. And I was like, well, it looks cheap, but there's dangers there. And then the dangers came out, and then the stock price fell a lot. So you compare this to AutoZone, even before that drop, and you say, okay, which one of these is easier to figure out what's going on? You know, AutoZone's a piece of cake. They spend all their extra money buying back shares, and they keep growing. I mean, it's pretty simple, and they've been doing it for years. O'Reilly, I own AutoZone. I don't own O'Reilly. O'Reilly looks like this, and then you look at advanced auto parts, and it's like, why even mess with them? So we're never under any obligation to like spend our time working on things that just make our lives more difficult. So anyway, when I see stuff like that, that's how I think about it. But I decided to go ahead and try to do my best with this, and somebody asked me about it. And I put it in my spreadsheet here so we could run some numbers. So what I basically did was I said, okay, who knows what happened back then? We have some information here. Analysts are pretty solid about their future earnings growth expectation. I put in 13% as my assumption, and that's a little less than some of the others, but it's right in line basically with the industry. And then I use this 2020 drawdown as my recession drawdown, which is actually what I'm doing with quite a few others, because the drawdown in 2008 was so deep that they'll never get that cheap again, probably, unless something really crazy happens. So it's like, okay, let's just use those assumptions and let's just run the numbers, and we can kind of see what we get. So that's what I did. So let's see here. We have quite a few things to consider. First is I pulled forward next year's earnings, which are expected to grow quite a bit. So I'm looking all the way forward a little bit more than a year, because these haven't actually been reported yet. But for my recession PE, I use the more conservative one that's almost in already. And so I use this, which I'll get to that in a second. So I have a more optimistic, and then I'll have a more pessimistic buy price. The optimistic one's going to use this earnings growth. It's going to assume it just grows at 13% uninterrupted for 10 years. This one will assume the recession PE will assume that the stock falls down somewhere like this. So if you just look at that's like a 10 PE, it's actually slightly lower than that. And right now it's 18. So just doing the quick math, you can say, it probably fall like 40% deeper, all other things equal, which might be what I forget what it is. We'll look at in a second. But so that's what the more conservative recession bear market estimate will look at. And they both assume 13% earnings growth. So we have 13% earnings growth. This is the earnings that's based on. That brings us to a PE ratio of 15, so that's better than the 18 that we were looking at. I do control for debt a little bit, which was about 10% actually. So I increased the stock price by 10%. So this is the actual stock price adjustment that I make in order to get this earnings yield. So the more you raise the price when you do this calculation, the more conservative you're going to be with the earnings yield. So it'll create, basically you're paying for the company with this, and the debt, company and the debt with this price. And that's the thinking behind it. And then I just do that quick calculation by taking the difference so I can do it fast. I just take the difference between the market cap and the total market, the total enterprise value here. So I just see how much of a percentage higher the total enterprise value is than the market cap. And then I adjust the stock price that way in my spreadsheet. Okay, so we have a 5.72% earnings yield. The way I like to think about that is if I bought the whole business for $100, I would earn $5.72 in earnings a year. Plus that $5.72 grows at 13% a year. I want to know how much money on my $100 investment I could make and collect in 10 years, which is $219, which is 100, if not, that counts the original 100, so an extra 119. And then I convert that to a CAGR percentage, which is what the spreadsheet does, and that gives me an 8.16 CAGR. So above 8 is a buy for me. So really right now, let's see, below 386 would be a buy if we assume there's like no recession and we're just growing and growing. We don't have to worry about it. We're not going to get a drawdown or anything significant. So that actually looks okay if you're being pretty generous to the business. And so, you know, it would be decent. Like it's not looking too badly if things go well for them and they can really grow at something close to 13%. If there is a recession, actually my quick math over there was pretty good. It needs to fall another 42% to get down to 219 to hit my buy price. So that's a pretty big gap, obviously, and it just really depends on how bearish or bullish. I'm still in pretty cautious mode right now, so I'm still using this number. And what I would say is if you compare this to something like a stock I don't own yet, Humana, I like Humana a little bit better. This number is a little bit closer. I think it's more like 20%. And the valuation looks a little bit better to me, just on the metrics that I use. But they're always kind of ballpark similar. Like I said, I've been able to pick up a couple of these healthcare stocks over the years, and I just kind of pick one up one year, pick one up another. I would say this year Humana has a decent chance. If we get like a little bit of a drawdown, I might add it too. And so that's kind of where I stand. So I would go that route before I went into one that didn't kind of have the clean history. So if we were going to I'm just talking like S&P 500 healthcare stocks here. So you can kind of see the difference. I mean, it's just, there's still this lull period, but pretty steady growth and just pretty easy to figure out. So if we got a little dip here, that's probably a buyable dip at some point for me. So that's the route I would go, but I mean, there's probably not a lot of difference, honestly. It's just kind of the methods that I've kind of decided to use over the years. Okay, so that's it. If you have any questions, put them down in the comments. And if you have a request, drop it. If you like this, hit the subscribe button. I'll see you guys in the next video.